Hi, I'm Donny. Welcome to my new channel on personal finance. I hope that you find the information useful, and if you like my channel, please don't hesitate to subscribe. The first video is an overview about investing and the thought process that goes before making an investment. First of all, what is investing? Investing is the process of purchasing assets that have the potential to rise in value over time or generate income. Typical investments are real estate, stocks, and bonds. Investing can help you grow your wealth over time. It can also protect you against inflation. So, one of the way in which investing help your wealth grow over time is with an effect called the compounding interest. So to show you how compounding interests work, let's look at a timeline that goes from 0 to 3 years. In year 1, you invest $1,000, and let's say that you invest it at 10%. So in year 1, you would get $100 of interest. Now, if you also reinvest that interest, you will have $1,100 to reinvest, which will bring you $110 of interest in year 2. The total now will be $1,210 that you will have to reinvest at that point. So if you do it one last time, you will get $121 of interest, which will bring the total to $1,331. If you pay close attention to what's happening here on your interest income when you compare the first year with the last year. So in first year, you receive $100 of income. In your third year, you're receiving $121. So your interest income has increased by 21% in just 3 years. That's the power of compounding interest. Now, if you want to see the difference with simple interest, let's look at the example below. So again, you invest $1,000, you receive $100 interest, but this time you do not reinvest that $100. So you take it out, you spend it. So you still have only $1,000 after year 1, which brings you another $100 in year 2. Once again, you do not reinvest that interest. So you take it out again. So you still have $1,000, and the same again in year 3. So you can see that by always taking the interest out, by never reinvesting it, the income that you generate is much lower by year 3 between simple and compounding interest. That's the power of compounding interest. One of the other advantages of investing is protection against inflation. Inflation is the gradual rise in prices over time. So to show you an example, let's look below. Let's assume that you have $100. Now let's assume that the year is 1950. So you go to the grocery store, and this is what you can get in 1950 with $100. Now, if we fast forward and we assume the year is 2023, you go to the same grocery store, and this is what you will get with $100. That's inflation. The first step to investing is to define your investor profile. This will help you decide what type of investments are suited to your needs and situation. There are a few key steps in determining your investor profile. The first one is to define your goal. Why do you want to invest? Those goals are important because they are the driving force behind your investment philosophy. They also provide an important clue on your time horizon. If your goal is to save for retirement and retirement is 25 years away, you have a long time horizon and you can take more volatile investments. On the other hand, if your time horizon is only 6 months away, it is a short-term horizon and you should stay with safer investments. So in summary, you must first define your investment goals and establish your time horizon. The second element of your investor profile is your risk aversion. Two investors with the same time horizon and same goal might choose different investment styles simply because of their aversion to risk, that is, their tolerance to risk. To assess your risk aversion, you should ask yourself some questions such as: am I a cautious person? Do I prefer my money to be safe? How would I react if my investment dropped by 10%? This will guide you towards a less or more aggressive strategy. The third element is to understand your financial situation. So, what investments do you currently have? What risk are you currently exposed to? And your overall financial health. How much debt do you have? And how much can you save? How much income do you have? This will help you determine your risk capacity. Now that you have defined a few of your investor characteristics, you need to think a bit more about your investment time horizon. So, for example, if you define that you had a time horizon of 20 years, that is a long time horizon. However, there might be situations where you might need the money earlier. For example, if your car was to break down, would you need to stop your investments, or would you be able to find the money elsewhere? A good way to deal with this situation is to split your portfolio into some long-term investments and some other investment that may be accessible quickly if you need to. The last step in your investment profile is to assess your financial knowledge. Some investments can be complex and have multiple embedded risks. Before making an investment, it is really important to understand the risks that you're taking as well as the performance mechanism of the investment. So, determining your investor knowledge is very important because in areas where you have a good financial knowledge, you probably are able to take more risk and also get less advice. Whereas if you have very little knowledge, then staying with more prudent investment might be a better path for you. Beside the knowledge, you also need to decide on how much effort you want to put in your investment process. You could be very knowledgeable but have very little time to dedicate for analyzing investments. And that combination of knowledge and effort is very important in assessing which products and which investment types might be more suitable to your needs. In this section, we're going to discuss some of the more common investment types and how their characteristics can fit into the investor profile you have just created. The first type of investments are stocks. Stocks represent ownership of a company. So when you buy shares in a company, you become a part owner of that company. To buy stocks, you need a broker account in order to access the market. Stocks can be more volatile than other investments and are typically suited for investors with a long-term horizon and low to medium risk aversion. To highlight the volatility and the importance of a time horizon, look at the graph of Berkshire Hathaway. This is the 1 month graph, and you can see the volatility that goes with it. Now, if we switch to a 1 year graph, the line looks much flatter. And again, if we expand and look at the 10-year graph, then you can see the trend, and all the smaller movements seem just like nothing, and you just follow the whole trend. Investing in stocks usually require a bit of effort on your end. There are thousands of companies listed on stock exchanges across many countries, and you need to filter that down and do some research to decide on which one to pick. You need to read the financial statement of the companies that you want to invest in. This way, you will have a good understanding of their financial health as well as their business, but this takes a lot of time and effort. Another way to invest in stocks is to do short-term trading. However, this will be for people who have a good financial knowledge and a good tolerance for risk. Stocks tend to be more volatile than other investments, but they also tend to bring higher return and higher risk. Bonds are essentially the opposite of stocks. They represent ownership of the debt. When a government or a company wants to borrow money, they can issue a bond. So as an investor, when you buy a bond, you're essentially lending money to the company or the government. In exchange, you tend to receive regular interest income and a principal repayment at the end. These are the typical cash flows of a vanilla bond. So this would be a standard bond. Bonds comes with various different payment profile, but this would be one of the more common one. So let's assume a 3-year bond that pays 5% interest every year. So if we look at our timeline, initially we pay $1,000 to buy the bond. Then in year 1, we get $50 of interest. That's what we receive from the company or the government. The same happen again in year 2. We again get $50. And then in year 3, we get the $50 plus our $1,000 back. So we get $1,050. This is how a bond works. Bonds tend to be less volatile than stocks. They also tend to offer less reward than stocks because they are a bit safer. But bear in mind that these are general characteristics, and each investment will have its own risk-reward profile. To buy bonds is the same as with stocks. You would need to use a broker. Like stocks, ETFs are traded on a stock exchange. ETF stands for Exchange Traded Funds. ETF usually track an index. So for example, an S&P 500 ETF will track the performance of the S&P 500, whereas a FTSE 100 ETF will track the performance of the FTSE 100. So let's say that you wanted to invest in the FTSE 100. So the FTSE 100 is the main index in the UK. It is comprised of the 100 largest companies listed in London. Now, as an investor, if you wanted to have the broad exposure to that index, if you were to go and buy each company separately, that would require 100 different transactions, and that would not be very practical. You would also incur a lot of transaction fees for each of your purchases. Additionally, as prices move, you will have to rebalance your portfolio so that it stays representative of the index. So that's not the right way for an investor. Alternatively, you can buy an ETF on the FTSE 100. And that's a much cleaner way for an investor to get the exposure to the FTSE. You just make one purchase, you just buy the ETF. The ETF in the background buys exposure to all the different companies, but you as an investor have only made one investment, so you don't have to worry about various transaction fees, and you don't have to worry about things like rebalancing of the portfolio. So it's a nice and easy way for an investor to get a diversified exposure with a single transaction. Keep in mind that they do come with fees, although these tend to be low generally, but you should be aware of that. Before investing, it is really important to read the key investors information document, as this will highlight the main risk of the ETF. So in your investor profile, if you determine that you wanted to invest in stocks but did not have the knowledge or the time to analyze specific stocks, an ETF is a really good way to get exposure to the broad market. Similarly, if you determine that you had a bit more risk aversion, then an ETF might be a good solution for you because although it is volatile, it tends to be less volatile than buying individual stocks because of that diversification effect. Real estate is a popular alternative among retail investors. The type of real estate investments available are houses, flats, lands, forestry, and many more different other types. With real estate, depending on your goals, investment horizon, how much effort you want to put in, you have various different options. For example, you could have short-term trades, such as buying a property and renovating it and selling it on. Or you could have a more long-term approach, which might be buying a property and renting it out, thus generating an income over time. With real estate, investors tend to have less risk aversion. So for example, if stock prices were to drop 15%, some investors will decide to exit their portfolio, whereas with real estate, they tend to stick a bit longer with the portfolio. So the psychological impact of your investment might also be something you want to consider. One of the specificities of investing in real estate is that you can borrow money to purchase the asset. For a retail investor, that tends to be the only large investment where you can actually do that. And that's called leverage. So leverage can amplify your return, but it also comes with risk. So you really need to understand the whole investment. So to explain what leverage is, let's look at the house. The house costs $200,000, and let's say that you have a deposit of $20,000, that is 10%. And so you borrow money, you borrow $180,000 at 5% interest. Now, let's say that you close the investment after a year. So assume two scenarios. So at the end of the year, when you sell the asset, the house is down 10%, or the house is up 10%. So let's start with the down. So the house is down 10%. That means that it has lost $20,000 in value. You also pay interest on your mortgage, that is $9,000. So in total, you have lost $29,000 on your investment, but you only had $20,000 to start with. So that's a loss of almost 150%. Now, if the house price goes up, then the house is worth $20,000 more. You pay $9,000 of interest, so you have a gain of $11,000. So that's a gain of over 50%. So as you can see, leverage amplifies the return, whether they are up or down. We have a price that goes down only 10%, but our initial investment is down 150%. Likewise, when it goes up 10%, our equity return is more than 50%. An alternative way to invest in real estate without buying properties is to invest in real estate investment trust. These companies will invest in real estate and distribute the income generated to the investors. You can buy those real estate investment trusts on the stock exchange the same way you do for stocks and ETF. Again, be sure to read the investor information document before investing so that you fully understand the risks that you are taking. The last type of investment that I'm going to discuss in this video are simply saving accounts. Saving accounts are a common way to just save your money. You basically leave it with the bank. Saving accounts will generate an interest income that tends to be lower than for any other investment because they also have a lower risk. In many countries, governments will tend to protect deposit until it's up to a certain amount. So for example, in the United Kingdom, the government will guarantee up to £85,000 should you go bankrupt. Savings accounts are a good solution for investors that have a short-term horizon because you can get an instant access to those. You have the main two types are the instant access account and the fixed-term account.